Hi, and welcome back. Today we're going to be focusing on buying a home. So understanding your financing. Mortgages. What is a mortgage? A mortgage is an agreement between you and the lender that gives the lender the right to take your property if you fail to repay money you've borrowed plus interest. So mortgage loans are used to buy a home or to borrow money against the value of a home you already own. So there are 7 things to look for in a mortgage: the size of the loan, interest rate and associated points, the closing costs of a loan, including the lender's fees, the annual percentage rate, also known as APR, the interest rate and whether it can change. Is it fixed, meaning it won't change, or is it adjustable, meaning the interest rate will be applied if it changes? The loan term. How long do you have to repay that loan? And or whether the loan has other risky features such as a prepayment penalty, a balloon clause, an interest-only feature, or a negative amortization. So in reviewing, we have the outlines of the home loan terms, which is your length, principal, which is the amount of money borrowed. You have your interest rate, and that is the percentage fee of borrowing money, and your agreement, and that is your terms. So agreement to pay or home can be repossessed. So you have key terms: amortization, and that is the gradual elimination of principal. Equity, which means the difference between the market value of the property and the principal still owed. So you have a example such as the market value of a home, which is at $150,000. You have a principal, the remaining principal of $100,000. Then your equity is the $50,000, and that could be how much you put down on your home, or that is how much you have left on your principal and your home is gaining value. So when it comes to the various types of mortgages, you need to focus on a mortgage that is affordable for you given your other priorities, not on how much you qualify for. So lenders will tell you how much you're qualified to borrow. That is, how much they are willing to lend you. There are several online calculators that will compare your income and debts and will come up with similar answers. But how much you could borrow is very different from how much you can afford to repay without stretching your budget for other important items too thin. Lenders do not take into account all of your family and financial circumstances. To know how much you can afford, you'll need to take a hard look at your family's income, expenses, and savings priorities to see what fits comfortably within your budget. Also, other things that you should not forget when coming up with your ideal plan. Costs such as homeowners insurance, property taxes, and private mortgage insurance are typically added into your monthly mortgage payment. So be sure to include these costs when calculating how much you can afford. You can get an estimate from your local tax assessor, insurance agent, and lender. Knowing how much you can comfortably pay each month will also help you estimate a reasonable price range for your new home. So what is a conventional loan? It is your most common. It has your fixed interest, which means it doesn't change. You have a standard of 15 to 30 years, and it's good to take this type when interest rates are super low. So some mortgage loans are insured by the government. So if the borrower defaults on the loan, the lender is protected from the loss. Conventional loans are loans that aren't insured by a government. Conventional mortgage loans can be divided into 2 basic categories: conforming and non-conforming. If a loan is eligible to be purchased by Fannie Mae or Freddie Mac, it is a conforming loan. Otherwise, it's not a non-conforming loan. We'll get more into depth into those distinctions in a little bit. So, conventional loan requirements. Let's take a look at what the requirement would be for qualifying for a conforming conventional loan. So, for our purposes, we're strictly talking about single unit purchase transactions for primary residence, especially a typical home purchase. When it comes down to the down payment for a conventional loan, you'll almost always have to bring a certain amount of cash to the table yourself. You can't fund the transaction entirely with a loan. Making a down payment ensures that you have a stake in the home, which translates to less risk to a lender. If you make a down payment below 20%, you'll be required to pay a mortgage insurance, PMI, principal mortgage insurance, which helps protect the lender in case the buyer defaults. However, you'll be able to have your mortgage insurance removed once you reach that 20% equity in your home. With non-conforming loans, you can usually expect minimum requirements for a down payment to be larger, though it depends on the lender and the features of the loan. If your loan is non-conforming, because you're borrowing a sum that is larger than what is typically allowed with conforming loans, also known as a jumbo loan, for example, you may have to put down at least 10%, possibly more. Now we're going to focus on an adjustable rate. That means interest rates change every 1 to 5 years according to the current interest rates. Usually starts to much lower than a conventional loan. And it's good for people who plan to move in several years or for people who cannot afford current conventional interest rates. So what is a adjustable rate? That is an annual percentage rate, or also known as APR, and that reflects the mortgage interest rate plus other charges. There are many costs associated with taking out a mortgage. These include the interest rate, points, fees, and other charges. The interest rate is the cost you will pay each year to borrow the money, expressed as a percentage rate. It does not reflect fees or any other charges you may have to pay for the loan. An annual percentage rate, APR, is a broader measure of the cost borrowing money than the interest rate. APR reflects the interest rate, any points, mortgage broker fees, and other charges that you may pay to get the loan. For that reason, your APR is usually higher than your interest rate. Finally, we're going to focus on what is a graduated payment mortgage, GPM. And that means interest rates start low and increase over time. It's good for younger homeowners who do not have much money now, but will begin making more money throughout their career. A graduated payment, GPM, is a form of home loan that is favored by prospective homebuyers with lower incomes, or who may lack significant savings with such to purchase a property. Under the terms of a GPM, initial mortgage payments start out small, then increase over time. In effect, a GPM affords you the opportunity to purchase a piece of real estate now, although you may have less cash in hand. As a result, it's often a popular choice with first-time homebuyers, depending on their life circumstances. GPM can come with drawbacks attached, though, so it's important to do your homework before considering applying for one. So when it comes to shopping for mortgages, banks, credit unions, finance companies, and lenders all compare and contrast to find the best option. Pre-qualification is how lenders determine if you fit the basic financial criteria for a home loan. To get pre-qualified, you tell a lender some basic information about your credit, debt, income, and assets. And it tells you how much you may be able to borrow. Tell is the key word here. The information used for pre-qualification is self-reported, which means the lender typically doesn't verify it or look at your credit report. So how to use a pre-qualification calculator? The pre-qualified calculator can provide an idea of what to expect before you talk to a lender. You need to have a few pieces of information about you and your finances, such as you need to have your annual income, which is your before taxes. You need to enter the term of the mortgage that you're considering, 10-year, 15-year, 30-year, meaning fixed, APR, or graduated. You need to enter the interest rate for your mortgage, and that's where you go online and you find today's mortgage rate. Select your credit score range. If you're not sure, go to Equifax and you can find out. Tell them about your employment status. How long have you lived? How long have you worked at a business? Do you have a down payment? How much? Do you have any past foreclosures or bankruptcy that they need to know about? And then enter your monthly reoccurring debt payments, and that could be electricity, utilities, car payments, and other credit cards that you might have. So that is how you get a pre-qualification for a loan. It saves a lot of time when you're looking for the house that you want, and it could also help you on negotiating prices on your future home just by having that information up front.